Last week I told you about an options portfolio designed to make 100% over 4 weeks. While it probably won't be quite that good, it might come close. The first week was encouraging. Just how did we do? Apple had a great week. It gained $20.29. That worked to be about 4%. Anybody who owns stock in Apple is a happy person. They gained 4% last week. However, our option portfolio people are even happier. We gained 35%, almost 9 times as much as the stock gained. Ironically, if the stock hadn't quite gone up quite so much, we would have made even more. But we're happier with 35%. First, let's take a look at the trades that we made last week. As the stock price rose $10, we had to roll our short calls to higher strike prices. We bought back the 505 call that expired last Friday, the February 4 series, and we bought that back and we sold March 1 series of 515 calls. They expire on March 2nd, next Friday. We had to pay $265 for each one of those spreads that we rolled up. And the same day, we rolled up the 510 short calls to the 520 strike for the next week. And then on Friday, the day that the February 4 options expired, we bought back the 515 call and replaced it with a March 1 525 call. We had to pay out $111 for each one of those. And then we bought back the 520 calls that expiring that day, and we sold 530 calls that expire next Friday. We collected $147 for that one. So let's look where our present positions are. We now are short calls at every strike from 515 up to 530. If you recall, that's exactly $10 higher than the strikes that we were short a week ago. We still have our long positions that expire the third Friday in March at every strike between 500 and 520. What is the risk profile graph of these positions? You can see that if the stock stays just where it is right here, we gain close to $1,000, a little less than that. Or if it goes up to $10 higher, we gain about the same amount. That works out to be about 15% on our portfolio value of about $6,000. On the downside, just like a week ago, if it falls by $7, we're a break-even situation. Let's look what we do if it did fall, say, $5. We're getting very close to the downside break-even point. We would make a trade. What we would do is that we would buy back this March 530 call and replace it by selling a lower strike down at the 510 call. We would be selling a vertical spread. And we would be selling the 510 call, buying back the 530 call that we're currently short. If we did this, we would collect about $1,100 for every single trade. And what we would do would be to buy more spreads that would increase our total profit possibilities. But let's look what would happen just with that trade itself. On the downside, if the stock were to fall $10 from its current price, we actually would make a profit. Now, we don't want to do that until the stock starts falling, because if it goes up, then we wouldn't have to do it. Next week, I will update these results with another video. Let's hope for a flat or slightly higher stock price for Apple.